What is money? Let's talk money. In everyday language, we often use money as if it means the same thing as wealth. But in economics, money has a much more specific job. Money is that special something we use to pay for things. It's our medium of exchange. It's also the thing we use to put prices on goods and set wages, the unit of account. In the United States, almost everything, prices, wages, you name it, is tagged in US dollars. So the dollar is clearly the unit of account here. But when it comes to actually paying for stuff, things get interesting. Sure, dollar bills and coins are still around, but most of us don't use them for everyday transactions. Instead, we swipe debit cards, tap credit cards, or use all sorts of electronic payment methods. In these cases, we're not really paying with physical dollars. Instead, we're giving a promise from our bank to pay those dollars on demand. For example, when you use a debit card, money moves from your checking account to the seller's account, but those funds aren't physical dollars. They're a promise from your bank to pay the dollars when needed. Traditionally, the amount of money in the US economy was measured by adding up all the cash in circulation and the deposits people had in banks. This measure was called M1. But today, we have many other assets that are liquid, meaning they can be easily turned into cash. Think of savings accounts or money market funds. You can quickly move that money into your checking account and use it to pay for things. Because of this, it makes sense to include these liquid assets when we talk about the total amount of money in the economy. In 2021, the Federal Reserve decided to expand M1 to include savings accounts. They also keep track of another measure called M2, which includes everything in M1 plus time deposits and money market funds outside of retirement accounts. Before 2021, M2 was much bigger than M1, but now they're pretty close. But wait, there's more. There are other assets like treasury bills, bonds, stocks, and more that are also pretty liquid. They can be quickly sold and turned into money, even if they might lose some value or take a bit more time to convert. The Federal Reserve also tracks something called the monetary base, or high-powered money. This includes all the cash in circulation plus the reserves that banks keep at the Federal Reserve. The monetary base is important because it's what the Fed has direct control over. M1 and M2 include different types of deposits, but the amount of these deposits is influenced by how banks, households, and businesses behave. Some people say that banks can create money because they can issue deposits. This is true in a way because more deposits mean more money in M1 and M2. That's why deposits in other parts of M1 and M2 are sometimes called inside money. Now let's talk about another role of money storing value. Besides being useful for buying things and setting prices, money can also hold value over time. But this role isn't as important as its other functions. Most people have other ways to store value, like owning a house, stocks, or bonds. The richest folks usually keep most of their wealth in assets other than money, like real estate or private businesses. The downside of using money to store value is that it doesn't give you much return. Cash gives you zero interest, and even bank deposits offer lower returns than stocks, bonds, or real estate. The reason is that cash and deposits are super liquid, they're easy to spend. But this liquidity comes at a price, lower returns. So it's smart not to hold more money than you need for everyday expenses, because you could be earning more by investing elsewhere. What role does money play in the economy? Money's main job is to make transactions easier. To really get this, imagine a primitive economy where everyone is self-sufficient. Each household grows its own food, makes its own clothes, and so on. In this world, there's no need for money because there are no transactions. But what if someone in this society realizes they're really good at making shoes and decides to specialize? Now, instead of making everything they need, they just make shoes and trade them for other things. As more people specialize, trade starts to grow, and an important question comes up: how do they trade? The simplest way is barter. Person A has shoes and wants bread. Person B has bread and wants shoes, so they trade. But what if person B doesn't want shoes? Now we've got a problem, which we call the double coincidence of wants. One solution is to find a three-way trade, but that's tricky to arrange. Another solution is for the shoemaker to accept bread as payment, even if they don't really want it because they believe they can trade the bread for something they do want. In this case, bread becomes money, the medium of exchange. But bread isn't a perfect form of money because it spoils. Sellers would need to spend it quickly before it goes bad, which could create inefficiencies. A clever baker might solve this by issuing bread tokens, little coins or pieces of paper that promise a loaf of bread. These tokens could circulate as money. But this system isn't foolproof. There's the risk of counterfeiting. People might make fake tokens that look real. Or the baker might issue too many tokens, reducing their value. The success of this system would depend on people's confidence in the baker's promise to deliver the bread. These challenges are similar to those faced by governments, central banks, and other money issuers when designing a monetary system. We'll dive deeper into these issues later, but first, let's think about what makes a good medium of exchange. Here's a list of qualities that make for good money. Highly standardized, easy to verify, high value relative to weight and size, easy to divide into smaller units, and stable in value. These qualities are important because money's job is to reduce transaction costs. If money isn't standardized or easy to verify, people might try to pass off low-quality money, leading to something called Gresham's Law: bad money drives out good money. This can be a problem even with metal coins if their weight or purity isn't consistent, requiring sellers to inspect the money carefully before accepting it, which increases transaction costs. Money that's bulky, like cows or tobacco, is also a hassle to trade. Items with high value relative to their size, like gold, are more convenient to carry. Paper money and digital entries in bank accounts are even better. They're super easy to move around. Money also needs to be divisible so you can use it for both big and small transactions. Imagine trying to buy something small with a cow. Good luck. The US penny, worth very little, makes it easy to handle even tiny transactions. Finally, money should have a stable value. This helps keep prices stable, which makes the economy easier to navigate. When we say money should have stable value, we're really saying that inflation and deflation are costly. Stable money means a stable economy. Some people think money should have a fixed supply. This makes sense because when money loses value, it's often because there's too much of it. But just because a fixed supply prevents inflation, doesn't mean it keeps money's value stable. The demand for money changes, and if the supply can't adjust, the value of money will fluctuate. An ideal monetary system adjusts the money supply to keep its value stable, which is what modern central banks aim to do. This idea isn't as widely understood as it should be. Take Bitcoin, for example. It's designed with a fixed supply, but this makes its value unstable. Despite its success as a concept, this instability hurts Bitcoin's usefulness as money. Finally, let's consider what happens if money has no actual value. Using valuable objects as money is costly. If we can use valueless objects like paper or digital entries as money, it frees up valuable resources for other uses. This idea goes back to Adam Smith, who argued that replacing gold and silver coins with banknotes would free up those metals for trade or lending, boosting overall consumption. Please like and subscribe.